Right, good morning, good afternoon, good evening, everyone. If I could just quickly do an audio visual check, make sure that you can see my screen. Okay, it should say VT Markets Understanding Market Phases, and also that you can hear me loud and clear. Just a quick audio visual check, possible, please. Perfect. Thank you very much, Catherine. Thank you very much, Marcus, Mark. Right, welcome to the trading vault. We're going to give it sort of five minutes or so for more people to join us. I can see that a lot of people have already started introducing themselves in the chat. That's great. We've got people from Sweden, Norway, Kazakhstan, Thailand, UK. So great to see so many of you here. Yeah, have you got? How long have you guys been trading? What are you looking to get from the session? If you could tell us a little bit more about that, that'd be much appreciated as well, just while we wait for a few more people to join. Okay, Andrew, newbie, good to see. Good luck with your journey. Hopefully you can learn something something new here. Catherine, 4 weeks as well. Vito saying no voice. Just I'm guessing. Are you saying you can't hear me, Vito? Okay, so we've got a few new guys new to trading. So like I say, hopefully we can get some new information for you today. Get you started on the right track with your trading journey. Yeah, that would be great. Yeah, so quite a few new to trading to here today, which is good to see. As we go through, obviously, if you are new to trading, as we go through the webinar, please do feel free to answer questions. I'm going to try and keep this as simplified as possible. There will be some technical stuff in here, but one of the main reasons that we're doing this, and certainly this webinar, is just to simplify things. I think a lot of trading can get a little bit overcomplicated. So we're here really just to try and simplify things, which hopefully will get you started on your journey in the right way as well. For those of you that are new to trading, what sort of instruments are you looking to trade at the moment? Do you know? Are you still sort of like learning your way, finding your feet? Are you looking to be day trading, swing trading, or just really trying to find yourself and find your way in trading? At Bashir, 8 years into trading, that's so a long career already. That's good. Day trading, gold intraday, swing trading, day trading. Okay, cool. So a mix. Well, look, hopefully, like I say, this session, what we're going to be talking about as well, we'll be able to transfer across all types of different trading. So we've got scalping, so you've got ETFs, day trading. Yep. So what we're going to talk about today is more of a generalization of the markets, how to view them, and how to adjust ourselves to the changing markets as well. And that can be transferred whether you're scalping, whether you're day trading, whether you're across all asset classes, all time frames. So I'm sure you're going to get a lot of information from this. With there being so many of you on here that are new as well, what would be really appreciated is I'll remind you towards the end of the session, but there will be a very short survey that we would like you to stay on for and take part in, if that's possible. That will allow us to find out what exactly it is you want to learn from these webinars that we're going to be starting to put together, so that we can really tailor it to what you guys want as well. So if you wouldn't mind staying on towards the end, it'll just be a very short survey, just so we can identify what it is that you guys want to see from these webinars as well. Okay, perfect. Vito, you can hear me now, which is good. Okay, cool. Right. Well, hopefully we'll get some more people on. But as I say, please do feel free to ask questions as we go through. We have got the chat box and the question and answer box, so I can see those questions. If it's relevant to the point, then we'll maybe try and stop and answer the questions as we go. But other than that, we'll try and keep the presentation flowing, and we can come back to some questions towards the end as well. So, look, again, thank you very much for being here today. This is the first episode of the Trading Vault, which is a webinar series with VT Markets, so that we can provide high-level education for traders of all levels of experience as well. So whether you're a beginner, whether you've been trading for plenty of time, no matter what style of trader you are, no matter what instrument you trade, you will be able to get a lot of information from these webinars. So really delighted to be hosting this one. Really delighted to have you here. And the first topic that we're actually going to to cover is understanding market phases. And the reason I chose this one to start was, I think especially in the markets at the moment, we're obviously got a lot of volatility because of all the geopolitical issues that are going on around the world and globally at the moment. And we are seeing lots of different changes into phases of different markets. So, and a lot of traders fail to identify early enough and can actually end up losing hard-earned gains by not being able to identify and almost by overcomplicating the process. So in this session, we're going to really sort of simplify the process and really give you some very basic details of how you can identify early on when a market is changing phase so that you can adjust your strategies and adjust yourself to those market changing conditions and therefore keep you safer. So first of all, I'd just like to introduce myself. So my name is Ross Maxwell. I am the VT Markets Global Operations Strategy Lead. I provide high-level educational content for traders of all levels. Like I say, whether you're a beginner, whether you're an experienced trader, I work with all levels of experience in trading and can add value to anyone. So I am a professional trader and I'm an investment manager as well. I'm an award-winning trading coach and mentor, and I'm a founder of a Keyzone Traders, which is an online trading education company. So when I say I'm experienced, I've got more than 20 years experience in trading the markets. I started my career in London and spent some time in London and Hong Kong before in 2014 I quit and I became an independent full-time trader myself. So I have a lot of experience both from time in working in the city with institutions, but as well as an independent trader with my own capital. But I've also been coaching traders from around the world for about the last sort of 8 years now. Again, all different levels of experience and different types of trader and trader profile as well. Okay, so as I mentioned earlier on, I think one of the biggest issues that we have is people overcomplicate market phases. We're going to run through some things now, and again, some of these might be a little bit technical, but for those of you that are new, but hopefully as we go through this and circle back round to it towards the end, you'll start to see how much simpler we can make this sort of this part of trading. So our job as a trader is to identify if there is a dominant side of order flow. So that means, are there more buyers in the market at the moment or are there more sellers in the market at the moment? And we need to adjust our strategy based on the market phase and the phase of the market we're in. So if we're having a trending phase of the market, we want to be staying with that dominant side of the order flow. So if there are more buyers in the market than sellers at the time, then we're going to see this trending market, and that is the side of the market that we want to be participating in. If their order flow is more balanced, so if buyers and sellers are generally sort of balanced, then we're going to see these choppy phases of the market where actually a lot of people and a lot of traders lose their money. But if we can identify those phases early enough, then we can adjust our strategies to more reversal-based strategies and therefore take advantage of that phase of the market. So as I say, this sort of idea of market phases is often overcomplicated, and we're going to go through some of the reasons why I think it's overcomplicated now. Now, if you look at all of these patterns, we've got double top, head and shoulders, rising wedge, falling wedge, inverse head and shoulders, double bottoms. These are all reversal type patterns. I'm not going to go into the details of what these are. This is more just to illustrate how complex things can be, because a lot of traders try to learn all of these different types of these different types of patterns. And the problem I always find as well is that when you go into the charts, very rarely will the pattern look exactly like it does on these sorts of drawings and diagrams that they teach in the textbook. So you get all of these different types of patterns and formations and phases of the market, but actually when we come to the reality, they look very, very different. Obviously, every now and then we get like the classic pattern which looks exactly like it does, but the majority of the time we really don't see the pattern set up exactly the way that it's drawn on a pretty diagram. And then we've got continuation patterns. So these are ones that we would take in trending markets. So you've got a falling wedge, we've got bullish rectangle, bearish rectangle, rising wedge, bullish pennant, bearish pennant. And you can start to see as well, like if you've got to identify, especially for those that want to do scalping or day trading, you have to think really quickly, especially when you're learning, trying to identify the phase of the market, the pattern, and then what you're supposed to do in the decision you're supposed to make on the back of that pattern. It can get really, really complicated, and you can miss. It's almost if you're new to trading, you may have heard of analysis paralysis, whereby you're facing with so much information and so many decisions that need to be made that you end up paralyzing yourself from being able to make those decisions. And then finally, we've got these bilateral patterns, which means we can use them in trending and reversal markets. You've got ascending trials, descending trials, and symmetrical triangles. So again, if we go back through that's sort of, what's that, 15 different pattern names that traders try to learn when they're starting. However, actually, and we're going to circle back around to this right at the end, we can simplify this into just two market phases. So these are impulsive versus corrective moves. An impulsive move is a trending move, and a corrective move is that sort of choppy corrective phase where we're going to be looking for more reversal-based strategies. So as I say, this is a simplified way of identifying the market phase. So rather than having a look at something and going, is it an ascending trial, descending trial, triangle? Is it a wedge? Is it a range? You know, rather than trying to decipher that, we literally look at something and say, are we in an impulsive phase of the market, or are we in a corrective phase of the market? It's literally just simplifying it into two different phases. Personally, I use an 8 and 20 moving average to help me identify this. So again, this is through my personal choice. There's no scientific reason behind that, but you want to be using a fast and a short-term moving average. So, anything from a sort of 6, 7, 8, 9 sort of moving average, and anything sort of like from an 18 to 25 moving average you want to be using. I personally use an 8 and a 20. Those are because those are the ones that I used to use when I worked in the city to make my decisions. Those are the ones that I believe a lot of people did use then and still use now. So those are the reasons that I use those moving averages. But basically, we want to use a fast and a short-term moving average to be able to help us identify that. And we're going to go into a reason why. And again, this is not just a moving average. We don't need lots of fancy indicators to tell us when we're moving into different phases of the market. Just very simple moving averages can allow us to give us the characteristics of the market phases as they change from impulsive to corrective and vice versa. And as I say, by being able to identify this quickly, it helps us adjust our strategy to the market phase. So it helps us adjust going from trend-based strategies into reversal-based strategies when we're going from an impulsive into a corrective phase, and vice versa. Rather than looking at reversal strategies, we can switch to to trending strategies when we can see the market moving into that impulsive phase. So first of all, let's look at the characteristics of an impulsive move. Now, again, what we're going to do is going to give you exact characteristics of impulsive moves, of corrective moves, so that you can actually easily identify them in the chart and as they change from one to the other. And we're going to look at some charts as well to be able to identify this and show you and give you some little tips on, again, simple ways that we can identify what sort of phase of the market we're in. So impulsive moves means that we identify the dominant order flow in the market. We can see that there are more buyers than sellers, or more sellers than buyers if the market's moving down. And by doing this, it allows us to establish a bias and therefore only trade with that side of the market. Again, if you're new to trading, you may have started to hear phrases like the trend is your friend, and that sort of thing, where we want to stay with the trend as much as possible. And by being able to identify the dominant order flow in the market, which one we want to be behind, we know then whether we want to be focusing on buying the market or if we want to be focusing on selling the market. And again, when we're in these impulsive moves, again, just to clarify, we want to be trading breakout and trend-based strategies. So impulsive moves, they have a strong imbalance of order flow. So one side is dominant over the other. As I keep saying, there are more buyers in the market than sellers, or there are more sellers in the market than buyers. We're in a trending market, so we want to be trading trending strategies. But also, this is another key point. When we're in impulsive moves, we want to be going for larger profit potential. We want to be going for higher risk to reward trades. That means that if we are risking, say, 1% of their account, we want to be going for 2, 3, 4, 5, 6 to 1 risk to reward to make more profit when our trades go in the direction that we want. And again, this will become much clearer in a few slides as we start to look at those impulsive phases of the market and why we can therefore go for larger profit potentials on our trades. So let's have a look at the characteristics of an impulsive move. It's really important that we note these down as well, because these are the characteristics that allow us to easily identify when we're in this phase of the market. So what do the candles look like? Well, generally, they're all going to be of the same color and they're going to be moving in the same direction, and they will generally be larger than the average size of the candle. So if, depending on the color settings of your chart, if we stick to standard, green candles are bullish and moving up, red candles are bearish and moving down. Generally speaking, when we're in an impulsive move, if we're going an impulsive move to the upside, the majority of the candles will be green in color and they will be larger than the normal size. And if we're moving down in a trending down market, majority of the candles will be red and moving down and in a larger sort of size as well. The momentum of the candles, so there will be little overlap on each candle. So from one candle opening, they will generally carry on moving in the same direction with very little retracement, and it will finish close to the high of the candle when we're moving up, or close to the low of the candle when we're moving down, and you won't see many wicks. It will generally be quite large bodies on show as well. Now here's where the EMAs come in. So retracements are often held by the fast moving average, which is the 8 EMA. I use the exponential moving averages. The fast moving one will generally hold an impulsive move. They do sometimes go back and visit the 20, but generally, when you're in a trending market, the EMAs will be holding the price action. They almost act as dynamic support and resistance to keep that trend in place. The EMAs will also be pointing in the direction of the trend, and they will be moving apart. So the 8 moving average will be above the 20 moving average, and there'll be clear gaps in between the two when we're in a trending up market, and when we're in a trending down market, both moving averages will be pointing downwards, and there will be a gap between the two there as well. Now, here's another point. Generally speaking, our holding times will be shorter in impulsive moves because their markets will be moving a lot quicker. And we can look to hold those runners on positions to maximize profits, as we spoke about earlier on. Going for those bigger risk to reward trades, maximize the profits of the trades that we get in when we can get these really strong trending markets. So let's have a quick look at this in action. So as you can see, this green box here is an impulsive move to the upside. And again, you can see the majority of those candles are green. A lot of them, especially in the early phase of this market, all close towards their highs. Very little overlap. They're all moving in the same direction. Pulls back to the 8 moving average, goes higher. This one does pull back to the 20 before it pushes higher. So the candles are of the same color. They're larger with less overlap. And the moving averages, can you see the 8 is the blue moving average, and the yellow line here is the 20 moving average. And notice as soon as this sort of phase of the market starts, this early on, you can see that separation in that 8 moving average and that 20 moving average, creating that gap. So you can identify early on in this phase of the market that we're moving into a trending based strategy, a trending based market. We can switch to trending based strategies, and we've still got all of this move left to be able to participate in. So we can use these sort of characteristics to identify very early in the phase that we're going into that trend-based strategy, trending-based market, trending phase of the market, and we can therefore switch our strategies to suit that as well. So is that clear, guys? Just moving before we move on to looking at corrective phases, can we all see the difference there and the characteristics of the impulsive moves that we're looking for? Perfect, good stuff. Okay, so let's move on then to the corrective moves. Now this again is coming back into, this is moving away from a trending based market, and as soon as we start seeing the market move into a corrective phase, then we need to switch our strategies and we need to look for more reversal based strategies. So this is when there's no dominant order flow in the market. The buyers aren't more dominant over the sellers aren't more dominant over the buyers. You're going to see a much more balanced market. So the buyers and sellers are both participating, and you get this sort of toing and froing. When we see this, we want to establish clean areas of support and resistance, and therefore we then want to be trading from those areas. And if we can't see and we can't establish clean areas of support and resistance, then actually we probably don't want to be trading that phase of the market, and we want to be waiting for either the market to move into a cleaner phase of the market, or go back into a trending based market and move into the impulsive move when we can take advantage of those trending based strategies as well. So it's not to say we can't trade corrective moves, but we only want to trade the ones where we can establish clean areas of support and resistance. And if we can't establish that, then it is okay to leave that phase of the market until it becomes cleaner and we can establish those support and resistance zones, or the market moves back into a trending based an impulsive move. And again, all the markets go through these phases. No market has ever stayed in a corrective phase forever. No market has ever stayed in a trending phase forever. They do go from impulsive to corrective and back again. So it's just about showing the patience to be able to wait for the market to move into another phase. And as mentioned again before, when we see ourselves move into the corrective phase, establish those clean areas of support and resistance, and when we hit those clean areas of support and resistance, that's when we want to be using our reversal-based strategies. So corrective moves, there's no dominant order flow in the market. You're going to see a choppy market. Apologies, see I've made a typo here. This should actually say corrective moves. So there would be no dominant order flow in the market. You're going to get this choppy market. Again, we're going to show this in the charts in a moment, where the market is moving back and forth, and we want to be trading reversal strategies only. We do not want to be trading trend-based strategies in corrective phases, because this is where a lot of traders lose the money that they make in trending markets by the market chopping them out and then keep getting stopped before moving on in their direction. We want to be a lot more aggressive with our trade management on these in these corrective phases as well. So we want to be going for lower risk to reward targets. We want to be more aggressive when we're reducing our risk on our trade, and we will talk about this in other sessions in this Trading Vault series about how to manage risk as well later on in other webinars. But certainly for corrective phases, you want to be much more aggressive with your trade management, and you are going to be going for smaller targets and lower risk to reward trades. So let's have a look again at the corrective, the characteristics of the candles and of the charts in a corrective phase. And they are basically the opposite of an impulsive phase. So candles will be a mix of colors rather than all generally of the same color, and there will be a lot more indecisive candles. So they're going to be smaller or much closer to the average size of the general chart. Momentum, there's going to be a lot more overlap. Remember when we said about in the impulsive moves, they're going to be opening and carrying on in the same direction. This time you're going to get a lot more toing and throwing in terms of the candles, because we're going to see that balance between the buyers and sellers pushing each other back as they sort of jostle for position, as they move to position themselves in the market. So there's going to be a lot more wicks on show. And it's going to be on both sides of the body as the market oscillates back and forth. And this is another key characteristic, and again allows you to identify early on in the phase when we're moving from that trending phase, that impulsive phase, into the corrective phase. Monitor the moving averages, and the EMAs will be closer together and they will be a lot more horizontal. Remember, in the impulsive phase, we saw that the EMAs were all pointing in the same direction, and we're going to see in a second how in the corrective phase, the EMAs are going to be much more horizontal. They're going to be closer together, and actually the 8 moving average is going to oscillate, move back up and back below that 20 moving average continuously. So as I say, although we're going for higher targets in the impulsive phase and we're going for lower targets in the corrective phase, our holding times are generally going to be longer, because it's going to take the market a lot, because it's this to and fro and the orders much more balanced. We're going to see it's going to take a lot longer for price to move to our targets, which again is another reason that we want to be aggressive with our trade management, and we're going to go for those lower risk to reward trades, so that we can make sure we hit our targets within these phases. So our holding times will be longer when we're in corrective phases, generally speaking. So let's have a look at a corrective phase. This, again, this green box, you can see that price. Notice the difference in the moving averages between the impulsive phase and this corrective phase. Notice how you can see that blue line and that yellow line constantly crossing. Notice how we do see a mix of candles, a lot more wicks on show. You know, the order flow is much more balanced. And as I say, the sideways moving averages is a real key component of a corrective phase. And again, we can determine very early on that we are in a corrective phase, so we don't take trend-based strategies on when we're in a corrective phase. And again, you might sit there and say, this part early on in the phase looks like it's turning impulsive. You know, we've got some big green candles on there, pulls back, holds that sort of moving averages and pushes higher. You may very well take 1 or 2 losses in this sort of part of the market, but that's absolutely okay. We are not, as traders, it is not possible to avoid all losing trades. But notice, even if you took 1 loss in this because you thought you was moving into an upward trend, as soon as you start seeing this price here and the moving averages cross over again, we can then identify that we are in that corrective phase, and therefore we don't take any trend-based strategies, and we've got the rest of this phase of the market to be able to look for those support and resistance zones, and most importantly, actually, not get ourselves into trouble by continuing to take trend-based strategies when we're clearly moving into a corrective phase of the market. So again, even if you misjudge or miscalculate, or the signals are there that it looks like it could be an impulsive move, as soon as you see the corrective characteristics come into play, it's very early on in the phase, so that you can actually protect yourself and make the right decisions and adjust your strategies to be able to make sure you're taking the best trades for that phase of the market. Okay. And a top tip here, this is something that, especially for the new guys, the traders who are relatively new to their trading careers, and maybe this feels a little bit too technical. A very simple way of identifying whether you're in an impulsive phase or a corrective phase is literally, if you draw a box, you can use this on MT5, MT4. You draw a box from the high to the low of that market phase. Then an impulsive move, the box will be visually, it will be rectangular, and it will be vertical in shape. It will be very vertical and rectangular in shape. However, corrective phase move, the box will be horizontal and rectangular, or much more square-like. And we're just going to go and look at a chart to show how we can see this looks in different phases on the same chart. Oh, excuse me, sorry. Right, okay, so you can see here that we've got these blue boxes. These blue boxes here represent corrective phases of the market. The green boxes represent impulsive moves to the upside, and we've got a red impulsive move to the downside here. So again, notice here that the moving averages are very horizontal, with the rectangular box is horizontal. We start to see this separation in the moving averages. The candles all start moving in the same direction. It's holding that 8 moving average. We can identify very early, sort of in this area here, that we're moving into an impulsive phase of the market, and we can still capture all of the rest of this move, all the move up here, in that phase of that impulsive move. And again, the moving averages, you can see that they start coming back, not holding that 8 moving average. So again, early on in this phase, we start to see these moving averages leveling out, again, going horizontal. The market starts to not push away impulsively from them. And again, so early on in this sort of area, we may take a loss if we're moving from this impulsive, trying to take advantage of this impulsive move here. We may take a loss in this area here. But again, as soon as we get into this phase of the market, we switch our strategies. We stop taking trend-based trading strategies. We move into that corrective phase, and we keep ourselves safe in all of this phase of the market, where again you can see those moving averages level off and be horizontal. Now this is an interesting one. We see that impulsive move to the upside followed by an impulsive move to the downside. But again, notice how we see this really strong impulsive candle, and again, another really strong impulsive candle. Straight away, we can start to think very early on in this phase of the market that this impulsive phase to the upside is switched, and we don't take buy trades anymore. Again, we may take one losing trade, but there is enough characteristics in there in terms of that impulsive move to the downside with the bigger candles finishing on their lows, that we can identify that we may be switching from an impulsive move to the upside to impulsive move to the downside, again, to protect ourselves and switch our bias from buying to selling. But again, the important thing here is just to identify that this box is rectangular and vertical, as opposed to these rectangular and horizontal in the corrective phase. Another rectangular and vertical phase here, which shows this really strong trending market, before we then move into another corrective phase, again, showing that these moving averages are very horizontal and oscillating back and forth. So just again, before we move on, is this clear to everyone how we can identify early on in the phase what type of phase of the market we're moving into? It's a much more simplified way of looking at it, rather than trying to work out whether we're in some bullish pennant or triangle. It's a simple impulsive phase, corrective phase, how we can identify which strategies we want to be using on it, and also that we can use this very simple tip to be able to identify when we're in an impulsive and corrective phase. Okay, good stuff. Good stuff. Cool. Right, I'm glad that everyone is finding this easy to follow. And as I say, if you do have any questions about any of this, please do ask away. I'm more than happy to answer any questions that you have. So Tanvi says, is there a recording? Yeah, I believe there's a few people that have asked about the recording, and there will be a record, I believe, sent out of this after the session as well. Cool. Right. So we're now going to get a little bit more complicated. But in actually, the reason I'm showing you this is to also help you stay with the right size of the market, and potentially even profit much further. So in an impulsive move on a lower time frame does not change the overall phase of the market. And we're going to go into this at the moment. This is now we're getting onto this sort of multi-time frame analysis, where we're talking about, just because we're in an impulsive phase on a 5-minute or 15-minute chart doesn't mean to say that we're not in a corrective phase on, say, a daily or a 4-hour chart. And we're gonna look at this so we can like magnify into areas and actually use this to our advantage as well. And again, in likewise, if we see a corrective phase inside a larger impulsive phase, this doesn't change that overall phase of the market. An impulsive break of the corrective phase signals a potential change in that phase. So we're going to look at some examples of this now as well. Omid says the moving average is the 8 and the 21. So I use the 8 and the 20, Omid, but to be honest with you, if you use the 8 and the 21, it's really not going to make too much difference. These are visual guides rather than like some sort of scientific mathematical formula behind why I use them. So again, sometimes I think people try and overcomplicate the process of trading by looking for this holy grail of indicators and stuff on their charts, when actually, you know, we're using them as visual guides to help us and to assist us in our decision making. So if you use the 8 and the 21, it's really not going to make too much difference, but we want to be using, like I say, I'm using an 8 and a 20, and you want to be using something close to that. So with the rectangles, we would enter the market once the candles leave the rectangle. So yes, we can do. And again, we can have a look at that in a second in terms of like some examples. So what we're going to do now is look at a corrective structure inside that impulsive phase of the market and how actually we can use this information to get better trades on the lower time frames when we are in that corrective phase of the market, but the overall phase is still in an impulsive move. And I'm going to show you what I mean by this. Sorry, I don't know why it keeps going back to that. So an impulsive move will most often be followed by a corrective move. And again, as I said earlier on, we do not move from, no market has ever stayed in an impulsive phase forever, and no market has ever stayed in a corrective phase forever. So what we're looking for an impulsive, we're literally trying to identify whether we're in an impulsive move, whether we're in a corrective phase, and adjust our strategy to suit that phase of the market. Now, approximately, this isn't a hard stat, but approximately 70% of impulsive moves are the same direction as the previous impulsive move. And what I mean by that, and we're going to go and look at examples again in a minute, is if we see an impulsive phase, it will naturally move to a corrective phase at some point. 70% of the time, the next impulsive move will be in the same direction. So if we see an impulsive move to the upside into a corrective phase, 70% of the time, that next impulsive move will be to the upside, because again, remember, the trend is our friend. We want to stay with the stronger balance of order flow. So we want to stay with the stronger side of the market. So if we see an impulsive move to the upside, it means the buyers are more dominant. It doesn't mean to say that they will constantly move the market in the same direction. We will enter a corrective phase whilst they reassess, readjust, balance a little bit, take a bit of a breather, let the market settle. But if those buyers are still the dominant order flow, we will then see another move to the upside. So it'll be impulsive, corrective, impulsive, and we can use that to our advantage, like we're going to see in a minute, as we can look to position ourselves with the overall trend of the market when we are in that corrective phase. So this is going back to the original impulsive move that we looked at. So you notice here, this is exactly the same move, but we're going to zoom in to this little blue box here. So this was, I believe this was a 1 hour chart, but we're going to zoom in onto this, this part of the structure onto a 15-minute chart, and you're going to see, and I'd be able to identify how we can now use this to get a better entry on this phase of the market. So we've got a clear impulsive move to the upside, but if this was on the hourly or 4 hour, we can move down to a lower time frame to identify when we're in corrective phase and position ourselves with the overall trend in the market. So just because we're going to enter this corrective phase on the lower time frame, you can see that the overall structure, the overall phase of the market remains to the upside. And we can use that to get better entries, better stops, and better risk to reward trades. So here you can see that we have all the characteristics of the corrective move. The moving averages aren't on this, but you can quite clearly see that the market would be moving sideways. The moving averages would be doing the same. This rectangular box is horizontal in shape, and you can see that we are in a corrective phase. But from the original, if we go back a screen, even though we was in this corrective phase, the overall structure doesn't change. So how can we use that to our advantage? Well, if we know we are in an impulsive phase on the higher time frame chart, when we move down to the lower phase or the lower time frame and see a corrective phase, we know that there's a 70% chance approximately of the market continuing to the upside because the overall phase on the higher time frame is to the upside. So what does that mean? That means we can therefore identify clean areas of support in these corrective phases to get long and be able to get tighter stops on the lower time frame, knowing that we can get these bigger moves on that higher time frame to really take advantage of that as well. So going back to the question about the rectangles, would you enter the market once the candle leaves the rectangle? Yes, that is one way that you can do it. You can wait for this corrective phase to break to the upside to confirm that we are then going to see that impulsive phase continued on a higher time frame. You can do that. That's absolutely fine. And especially maybe if you are new to trading, you may want to wait for that confirmation. But if we know that there's a statistical probability that this phase will, even though we're in this corrective phase, that it's still going to go to the upside, we can actually look to get long from the lower edge of these support zones, and we can get tighter stops and we can get bigger risk to reward opportunities. So depending on your style of trading, depending on your trading plan, you can do one or the other, but we can use the overall by identifying the phase on the higher time frame, it allows us to stick with the overall trend, with the dominant order flow in the market, and that is what is going to give you your edge, and that is what's going to provide you with the best opportunities of becoming profitable as a trader. So any questions on that before we move on to looking at the opposite, which is looking at impulsive moves within a corrective phase? Okay. Right, so now let's go and have a look at an impulsive move within a corrective phase. And like I say, just because we see an impulsive move on a lower time frame, it doesn't necessarily mean that the overall phase of the market has changed. We can see corrective moves inside larger impulsive phases, as we just mentioned. And as I said, that impulsive move on the lower time frame does not change the overall phase. An impulsive break of the corrective phase signals potential change in phase. And that's going back to the question earlier on about waiting for the market to move outside of that rectangles before you start entering the impulsive phase again. That is absolutely fine. It's what determines you and your trade plan. And if you see that impulsive break of the corrective phase, then you can start to get long again. But we can also use the other way, the statistical probability to get tighter stops and better risk to reward trades. The thing that you will have, and this is the same with any trading, if you go for tighter stops and bigger risk to reward trades, generally speaking, you are going to have a lower hit rate, which means you're going to get stopped out more trades. You're going to lose more trades. This does not necessarily mean that is a bad or a worse system. You know, some of the best traders and most profitable traders only have 20 to 30% hit rates, but when they hit their winners, they can get multiple risk to reward trades. Others, you know, can have 70, 80% hit rates, but their targets are much smaller. So it's about balancing your edge, finding out what suits your trader profile. There is no right or wrong in terms of this, but what is the right way to do is to be able to identify the phase that you are in, identify the dominant order flow in the market so that you can stay with that side of the market at the time to give yourself the best edge in the market, and therefore give yourself the edge that can make money in the market. Okay, so again, we're going to look at, this was the going back to the original corrective phase that we looked again. Clearly, we can see that we've got a corrective phase here, and we said early on that we can identify in this area here that we're moving into that corrective phase of the market. However, if you're on the lower time frame, and we're going to have a look at this price action here again, you can see rectangular, vertical in shape, it would look like an impulsive phase. But when we can see that the wider structure of the market, the wider phase, the overall phase of the market we've identified early on is a corrective phase, we do not want to be jumping in just because we've seen that. So again, we want to be putting the emphasis of the phase of the market on the higher time frame to make sure that we stay with that side of the market. So if you're a day trader, if you're scalping, you might be using a 15-minute or a 1 hour time frame as the higher time frame phase of the market to be able to identify. If you're a day trader, it might be an hourly or a 4 hourly, and depending on the type of trader that you are, you want to be moving up the time frame. So again, if you're swing trading, you're probably going to be looking at the daily or weekly to gain the overall phase of the market, to give yourself the best chance of staying with the right order flow at that time. So let's zoom into this, and we can clearly see, again, it's got all the characteristics of an impulsive phase. It's the moving average is separated. We're all moving in one direction. The box is vertical and rectangular in shape. A lot of these candles are green. They're big. So it's got all the characteristics of that impulsive phase of the market. But just because it's on the lower time frame, it doesn't mean to say that the overall phase of that market on the higher time frame has changed. So it's again just making sure we are aware of the overall context of the market on the higher time frame to make sure that we're staying with that right phase of the market. Okay, so now I just want to go back again, take a little step back before we can open up to some more questions, if anyone has any. But I want to go back to those original diagrams to show how much more complicated, hopefully you can see, trying to identify all these fancy patterns and stuff is, when actually we can simplify it into impulsive, corrective, and that is all we need to know. So if we go back to these, all of these are an impulsive move into a corrective phase, an impulsive move into a corrective phase, impulsive move into a corrective phase. They're all either, even though it's a fancy name, actually they still all only have impulsive and corrective phases. So rather than trying to learn them and overcomplicating the process, we can actually just determine whether we're in impulsive or corrective phase, and therefore adjust our strategy based on that information rather than trying to work out what different pattern we are in. And again, it's the same on whether we're looking for trend-based strategies or breakout strategies, impulsive, corrective. So we're going to see, again, going back to the example of where we had the impulsive phase and we had the corrective move at the corrective phase in the middle of that impulsive phase, we see that impulsive move to the upside. We enter the corrective phase. We can move down to the lower timeframes to try and find out the best and cleanest areas of support and resistance on that lower time frame to give ourselves optimal entries, or wait for that corrective phase to be broken out of before we continue to resume taking strategies with that side of the trend, with that market, the direction that the market is trending on. And again, likewise here, they're all impulsive corrective phases. These are all the patterns in these moves are made up of either an impulse, or they are made up of impulsive and corrective phases. Okay, so that is the content of the webinar. I hope you have found that useful. If you have got any questions, please do fire away. I'm always more than happy to answer any questions and clarify any parts of the webinar. But if you would like to start trading with an award-winning broker, you can scan this QR code to open up a live account with VT Markets. With VT Markets, you get competitive spreads, you get institutional grade liquidity, and we also have lightning fast execution. So please, I'll leave that up there for a moment. If you would like to open a live account with VT Markets, that would be great. Great to see that some of you are already with VT Markets as well. That's great. I'll just leave that up there for a moment. As I said, if If you would like to stay on and answer the survey, we would really appreciate that as well, so that we can understand exactly what it is that you guys would like to see from these webinars going forward, the subjects and the topics that you would like us to cover, to make sure that we can get you as much of the information that you need as possible. Yes, we are going to be doing more webinars. This is going to be a regular series, and next one is in 2 weeks' time. So really looking forward to hosting these regularly, giving you guys as much information as possible to really help you in your trading as well. But yeah, please do give feedback. Please answer any questions that you have. Ask any questions that you have. Okay, we've got Louis in using. Okay, glad that brilliant that so many people have found it useful. Louis says, in using the 8 and the 20 EMA, what time frame this is most effective to be used on your end? Is it lower time frame like it honestly, again, Louis, so it comes back to it can, because we're just looking at price action. Okay, this is basic price action. We're not looking at instrument specific stuff. So this is really stripping it back to try and keep it as simple as possible in price action. And one thing that I have found over the years as well, I mean, again, I've been trading now for more than 20 years, you know, keeping the charts as simple as possible, really focusing on trying to read price action. Yes, it may take a little bit longer time to learn it, but it will give you the best foundations for making decisions. So the 8 and the 20 is the moving averages that I use, and they work on all time frames. It's just about it's about deciding what type of trader you want to be, deciding which time frames you're going to work on, and then adjusting it for that. So it's if you want to be a day trader and you decide that you want to trade off the 5-minute time frame, that's your choice of time frame that you want to execute from, then you probably want to look at like a 1 hour and use that for deciding the overall phase of the market that you're in. But somebody might want to execute on the hourly, and they're going to need to go to like the 4 hour or the hour or the daily chart. So it's not that it would work best on any one. It's identifying the time frame that you want to trade on, and then moving up to find out which one gives you the best overall context of the market and phase that market is in according to your execution time frame. Because again, if we think about it, just because we said that like an impulsive move on a lower time frame doesn't change the overall context of a market, but you could have someone trading the same market and on the high, like on the daily or weekly, they are in a corrective phase of the market. So they are looking for reversal based strategies on a 4 hour chart. However, on an hourly chart, you may be in an impulsive phase. So on the 5-minute chart, you are looking for those impulsive moves to follow the trend. So you can be trading the same market, but in different phases, depending on the style of trader that you are. And I think this is where a lot of people fall down in terms of multi-time frame analysis as well, is because they look at 4 or 5 different time frames, which all is telling different stories, and it creates that analysis paralysis and stops them making decisions. So you want to simplify it as well. You want to know what the overall phase is, but it's really important to really identify the type of trader that you are and adjust the time frames that you're looking at to suit that style of trader that you are. So I hope that helps. I believe we can put some more the registration links for the future webinars. I don't know if we can put those in the chat or how people can sign up for the next webinar. So Jackie's saying, I'm sorry to hear that you got caught up in the rain. Hopefully you're okay. But yes, there will be a recording of this session as well. Okay, well, I'm happy to stay here just for another minute or so, see if there's any other questions, but I'm glad that so many people have found this information useful. and are keen to come to the future the future webinars as well, I can leave that up there. Okay, so if you could hold on for a moment, we are just getting the future the link for the other webinars as well, so you can join and register for those now. That link will be sent in there very soon. So if you could just hang on for a moment, that would be great, and we'll provide you with that registration link for the next webinar. Okay, that's just been posted into the chat box as well. And for those of you watching this on record, if you do have any questions, obviously do please feel free to reach out to VT Markets, and I'll be more than happy to answer those as well. Right, okay, everyone. So again, I'd just like to thank you all for joining us tonight or this morning. I know we've got people from all over the world, so some of you it's the morning, some of you it's the afternoon, and some of you it's the evening. But I'd really like to thank you for joining us and taking your time to be with us. We really do appreciate it. I look forward to seeing you on those other webinars. And again, if you please could just stay on and get that answer that survey for us, it will also allow us to make sure we tailor these webinars to give you the information that you want from these and give you the best chance as well. Right, have a good day, everyone. Thank you very much.